Well, this is Current Yield Grant's Interest Rate Observer of the Year. I'm Jim Grant, and with me, as usual, is Eric Whitehead, our engineer, sound man, etc., and the great deputy editor of Grant, Evan Lorenz. And we also have Seth Wiseman, who is the founder of Urban Standard Capital, who in a few moments is going to tell us all about real estate in the city of New York. But, we awaken, we New Yorkers, and I dare say people throughout this country awaken to a sense of anticlimax and not a little confusion. And Evan, as he so often does, kind of encapsulated, miniaturized the sentiment. And he sent around a message to the staff, and the message in its entirety was, quote, "Nobody knows nothing," which reminded me of a line of accomplished screenwriter. William Goldman was a guy who wrote the screenplays for All the President's Men and Butch Cassidy and Sundance Kid, et cetera, et cetera. I think he died in 2018. Anyway, William Goldman uttered this immortal Hollywood line, quote, "Nobody knows anything," which was apropos of the predictive capacity of Hollywood executives to tell a flop from a hit. And nobody knew nothing with respect to their own business of predicting the success of a theatrical project, which I think is something to tell us about risk and investments as well. Evan, when you typed I think William Goldman would have been better advised to have said "nobody knows nothing," which I think is more emphatic. But what were you thinking exactly when you wrote that improvement on the William Goldman line?
I was thinking how sure the market, how sure pollsters were, and how sure very complicated models by the like of Nate Silver, New York Times, and everything else, exactly how the election would go down to the margin. And then I remember watching it last night and seeing it just get disappointed time and time again, which just goes to show you the world is more perverse than our models anticipate. Yeah,
I think George, I've spent a lot of time looking for a quotation I know came from George Orwell, and he said, in effect, the only time you're right, he said, is when your forecast coincides with your secret or not so secret hope. So anyway, so much for the fine art of prediction, which brings us, however, to the much more tangible world of bricks and mortar real estate in the market of the city of New York. And Seth Wiseman has made this his investment specialty. Seth, this reminds me of a line of one of the great investors who was asked, where is the outlook good? People would ask this guy, where is the outlook good? And he'd say, that's the wrong question. You must ask, where is the outlook terrible? By which, of course, he meant that presumably, with a known terrible outlook, there would be bargains. So, Seth Wiseman, tell us, are bargains surfacing in real estate in New York City?
Okay, well, I can do my best to help answer that question. We're very much in a moving marketplace where at the moment there is a lot of price discovery as buyers and sellers figure out where the bid is. And there's a lot of new information feeding the market every day, whether it's related to the reopening in New York and COVID or the election or other variables. But we have been, for the last couple months, seeing more opportunities and distress come to head. It's been delayed, and it still is not a flood of opportunity. And some of that is driven by two factors related to the governor's actions on evictions and the governor's actions on foreclosures. So at the moment, the foreclosure process is halted. So banks are not really able to sort of follow through on that process, and the courts are clogged. And as a result, what you're seeing is, everybody is sort of forced to work together, which is, I think, a good thing, borrowers and lenders. And then similarly at the property level, evictions halted, owners and their tenants are trying to work together to sort of land the plane as smoothly. But as those restrictions lift and people get a better sense of the marketplace, they're making the decisions of buy and sell and take, some loss or not and move on and reinvest in distress. In the last couple of months, we've started to see banks come to the market with more reasonable expectations on the price of their note sales and sellers as well.
Seth, one thing that's complicated this factor is, as part of the CARES Act, banks can put loans in moratorium and essentially not treat them as non-performing loans. And in New York, I know that some of the banks like Signature put large portions of their commercial real estate portfolios in CARES Act deferrals. How is this kind of affecting the cadence of distress coming to market? Because if a loan is in deferral and you don't have to make principal and interest payments, I assume you're not going to default.
Correct. That's exactly the right point, and that has bought people time. But lenders like a Signature Bank recognize it's just bought them time, and that time will come to an end. And so they have to make the decision, looking at their overall portfolio, what do they want to offload and at what price? Because they sort of pretending that there's not an issue there as it relates to the regulators. And at the moment, they're not, because they've been granted that exemption. That's going to come to an end. And I can't tell you, does that happen first quarter of next year, second quarter of next year, but it's going to happen. And so what we've seen is, a willingness from banks like Signature to entertain discounts on their notes that certainly in the second and third quarters of 2020, they weren't willing to entertain, but they have to plan for the future, and they want to put themselves in a position where they can, continue to actively lend at new price points and with new rates and on a healthier product. So, yes, it's bought time for everybody, but people are looking over the horizon and trying to figure out their plans today.
So what kind of total return might you be looking at today in, I don't know, say a middle kind of grade residential, an apartment building in the borough of Manhattan, neither glitzy nor rundown? What kind of cap rate? What kind of return on capital after making allowances for reasonable depreciation and maintenance expense? Just if you put this in the terms that an equity or a bond investor might understand, what is the opportunity now, given the complexities?
Before I speak about cap rate, that cap rate and price is tied as well to net operating income, right? And the operating cash flow of a property. What is a big change at the moment is where are rents, right? Rents, depending on your location, and even within Manhattan, it's different, right? Manhattan south of 96th Street is a different market than north of 96th Street. And one thing that we have seen is that rents are down 10 to 15%. In some cases, we've seen bigger discounts, particularly for larger apartments, roommate share apartments, 3-bedroom, 4-bedroom units, or uber luxury apartments. So, which there's a lot of. And that's driven by the fact that most businesses are not requiring their employees to come back to work at the moment.
Right.
So whether, it sort of goes in two directions. If you're a young professional and you're living with 2 or 3 other people and you can work remotely, and you were previously, part of the reason you were paying the freight of living in New York is you were paying for the cultural and social amenities, right? The ability to go out to bars and restaurants and cultural events. If you can't do that and you don't need to go to work physically, then why would you pay the freight to live in the city? And the answer for most people is you wouldn't, and you would find other places to go, which a lot of people have done. So you have that dynamic. And then you have the luxury rental market, which are people, if you're spending more than 5, 6, 7,000 a month on rent, which, for most people in America might be a horrifying thought, but it's pretty common in Manhattan, you typically have options. So you might have rented a house in Long Island or New Jersey or Connecticut or upstate New York because you're in an income bracket that gives you flexibility. You're also likely in an industry that is more conducive to working remotely and having, endless Zoom and Google Teams.
Okay.
So those two factors are putting a lot of downward pressure on rent. And I think, in terms of the pricing and cap rate, a lot of that depends, where buyers see rents going forward, right? Do they think this is a 6 to 12 month blip and then people return to their offices and rents recover to pre-COVID levels or 90% of pre-COVID levels? Or are these 20, 25% reductions here to stay? And, that will drive cap rate, right? And I think generally on mid-tier product, you're looking at cap rates in Manhattan in the 5 to 5.5% range. When you go to northern Manhattan and you go to parts of Brooklyn and Queens, that creeps up to around 6. But you have to be really careful about what your expectations are regarding rent levels. And, when you combine an expansion of cap rate from, say, 4.5% below, previously pre-COVID to 5 to 5.5 or 6% today, just mathematically, that alone is a 25 to 35% delta in value because of the way the multiple effect. You layer on top of that a decline in your rents, and you might be looking at a value that is 40% below where these assets might have traded a couple years ago. That's a very hard pill to swallow for a lot of owners. And the trades we are seeing happen are happening from long-term owners. So we've bought several assets in the last couple of months, and the profile of the seller has been consistent. People who have owned the buildings for 30, 50 years, who recognize that they're not going to get the peak pricing of 2016, but they also recognize that they've owned these assets for 30 to 50 years. They've still done very well. And frankly, many of them don't have either the time or the stomach to go through another cycle. And because they've owned the assets so long, they have a basis that gives them flexibility in terms of pricing. But that's a dynamic that has to exist. If you bought something in 2016 or 2017, you took a big hit in 2018 if there were rent regulated units with the rent law changes, and then you took a bigger hit with COVID. So you may not have any equity left in the property at this point.
Seth, you mentioned another cycle, and some people not having the stomach to suffer one. But these cycles can and do last. I mean, my goodness, the 80s seemed to go on for about 35 years, just that one decade. And, and how does one, time this, bearing in mind the William Goldman admonition, or the Evan Lorenz admonition about prescience, a little on clairvoyance. Something's down 40%, and yet you see that the mayor of the city of New York actually has a nickname called Blah, which seems to be well-earned. And you see that the street amenities are not what they might be. You are looking over your shoulder at the possibility of another cycle in crime and urban decay. And so do you proceed down 40% as to kind of a commanding valuation point, or are you waiting for the cycle to play out and perhaps seeing still greater bargains?
It's very situation specific. I will tell you, as an investor, and I manage both equity and debt funds focused on the New York tri-state market. On the equity side, of the 100 investors, say, I speak with regularly, 70% don't want to talk about investing in New York until we get through the election and through the winter reopening. The other 30% are very eager to be contrarian and step in. And to your question of, is this the moment? Do you wait? That's a very situation specific, answer. And I have family offices who feel that now's the time. They recognize that they can buy things at a steep discount to the cost of replacement, meaning the cost to buy the land, rebuild today. And they like that as a foundation for their investment thesis. And the reason there is that, if you're buying something for $1,000 a square foot that costs $1,500 a foot to replicate, well, that new supply can't come on and be competitive with you. So it's a nice sort of risk mitigant. But you might not be catching it at the bottom, but a lot of, at least for the family offices and foundations I deal with that might have a 5 and 10 and even 15-year outlook, they are not so focused on catching the absolute bottom. They recognize an attractive entry point. Maybe it's driven by being below replacement cost, or we sensitize rents and we sensitize operating income and key variables for cash flow. And if we feel like, we have the ability to weather a storm and still come out okay, we study probabilities of different outcomes. And if those probabilities overwhelmingly lead to a favorable investment result, that can offer a compelling investment thesis. But again, that's 30% of the conversations I'm having, and the other 70% at the moment are on hold.
Seth, at the start of this, you said that banks are beginning to offer notes and properties at more reasonable prices after the third quarter. How reasonable is reasonable, and have they come down to a level that's market clearing yet?
They have not come down to a level that's market clearing. Part of that is we're only in the last quarter starting to see the impact on rents, because you couldn't even show apartments until I think the end of June. And, what happened with schools didn't play out until September, and with companies reopening, a lot of leases in New York roll over the summer anyway. So pricing, it sort of has continued to chase downward as new information has come out, and people have said, well, wait a minute, I have to re-underwrite the value of these buildings, not at the 2018 and 2019 rent rolls, but at some discount to those rent rolls. And so previously, if you assumed rents would be the same or stay within 5 of where they were a year ago, well, then you could sort of come to a number and say, all right, well, Signature Bank, I can pay you 80 cents on the dollar based on that. Now you have new information coming into the fall. We're still on lockdown. We're still only at 25% of indoor dining. Most big companies are still not requiring their employees rather to come back. And so rents are not down 5 to 10%. They're down as 15 to 20%. And now that 80 cent on the dollar bid is 70 cents on the dollar. And a Signature Bank has to make that decision of, do they think this is the right entry point, or exit point, I guess, in their case. And so it's a constantly evolving market. But I think what we're starting to see is people are more realistic about where the world is and how long we're going to be there. And I would say it's been interesting on the financing side of our business. Basically, every developer and borrower who started a project in 2016, 2017, and we make loans on value add properties. So they're clients who are buying properties, making some improvements, and in theory, creating value as they do so. All those clients are really focused now not on their original business plan, which may have had a 2 times equity multiple or 1.7, 2 times equity multiple. They're trying to get their money back, right? I joke in my office that the new 2.0 equity that some people are saying if I can get 50 cents of every dollar I invested and move on and maybe redeploy that money into a down market, that's what people are doing.
So, hey, Seth, tell us, SL Green is a public equity, lots of liquidity, and its stock is down a lot. So how do you compare opportunities in brick and mortar, inherently illiquid, with the value on offer from SL Green?
So certainly there's a liquidity premium, right, that you have to factor in. But if you're comparing like private office to public office, which is what Empire State Realty Trust or SL Green or even Vornado to a certain extent, although they seem to have more retail as well. Obviously, if you're investing in the illiquid private markets, you're going to need some premium to account for the illiquidity. But there are opportunities in both spaces. The challenge there, again, is a rent challenge. The amount of sublease space on the market, the unknowns regarding absorption and pricing, make this sort of floor of value hard to determine.
In addition to the many unknowns that we have today, including who will be president and what the composition of Congress will be next year, we may actually have higher taxes next year. If we do get an increase in taxes, what does that do to the real estate market in New York and into property transaction values?
Sure. So certainly the devil is in the details. I don't think personally that the Trump administration has been good for New York real estate and New York generally for a couple of reasons. Part of it is the tax reforms that were passed were very negative for New Yorkers, specifically the inability to deduct New York state taxes against your federal income tax bill. New York state taxes I don't know if it's the highest or it's the second highest in the nation, but they're quite high.
It's the highest in the world. It's the highest in the world.
Is it? I thought California maybe was.
No, that was just an emotional outbreak.
Yeah,
I'm sorry.
I know that's how it feels. But I think technically we might be number 2. But so that was a big hit, right? The inability, if you were a suburban homeowner, to deduct your real estate taxes against your income taxes. That was a big hit. That was capped at $10,000. You go out to Long Island in Westchester, most of the homes have real estate tax bills in excess of $10,000. Further, it's a market where the reduction in the interest rate, cap from $1 million to $750, that was a negative. So those things have all been negatives for New York from the Trump administration. Additionally, there's sort of political elements. Trump embodies New York City real estate. That's been his whole, sort of spiel for his career and The Apprentice and everything. The far left in New York has been, completely encouraged and sort of baited by his presence. And so I think the animus that the far left in New York feels is being lashed out. And unfortunately, New Yorkers and New York City residents in particular are feeling the consequences of what feel like politically motivated, rules and regulatory constraints that are having the effect of discouraging investment and economic growth. I mean, it's interesting to me, not only the Amazon debacle as an example, but you just had Industry City in Sunset Park, where the council member who killed a project with 20,000 jobs and 100 million in tax revenue, which was a disaster for Brooklyn, and really should not have been squashed. He just announced that he's running for mayor, right? So all of a sudden, what should be billed as disqualifications, right? It's not something that one should be trumpeting. He thinks is a qualification, and he may be right.
The guy's a shoe-in. The guy's a shoe-in. This is what New York City stands for.
Well, and unfortunately, and I think there's an element of what's going on with the election is people are seeing what's happening in Democrat-controlled markets. Whether it's New York City or Chicago or Portland or LA or San Francisco, the images are pretty tough to digest, and I think people get spooked when they see what's happening here and in those cities. So, all this to say, a lot of this stuff is coming out of, a really strong feeling of anger and resentment toward Trump. I mean, he's the embodiment of New York City real estate. And so I think people are, it's an opportunity to strike back. And instead of having, pragmatic, progressive policies that, really encourage growth, you're ending up with, stuff that is just driven by this animus for the far left. So I think Biden win, frankly, lowers the temperature and puts somebody who's a more moderate, voice in place. And along those lines, I think Biden will negotiate a significant stimulus for New York. Trump has punished, not only New York, but other blue states and prevented much needed federal aid to support our small and mid-sized businesses and our most vulnerable population. I think Trump, if he's out, Biden will be able to deliver that aid to the city and to New York, which is good.
Seth, sounds as if you are, at least by the sound of your voice and by the content of your remarks, I would guess that you are a member of the value-seeking investment tribe, as opposed to, say, the momentum or the high-tech. Not just a surmise, I'm probably wrong about this, but if value is part of the real estate proposition in New York, investment proposition, let me ask you this. Value investing is absolutely out. I mean, it is, what's a level below a footnote in a book? I guess it would be part of the appendix. It didn't make it in the publication. But value investing is lagging. It is given up for dead. So why should the seemingly commonsensical search for a discount and a margin of safety in New York City fare any better as an investment return than has a similar search in public equities public equities. The stock market does not favor value seeking, it seems. Why should the real estate market favor value seeking?
So I think one thing to differentiate, value seeking is, as you said, it's often driven by basis and it's driven by a margin of safety that provides some optionality. The other thing to add to that may not be as readily accessible in the securities markets, for your average retail investor, is if you're a value-focused investor in New York, and you're right, we are one. It's not just the cost basis being below replacement costs and having that optionality and different path to profitability. It's also about the concrete steps you take at the property level to grow the value, right? And that could be everything from renovating apartments to achieve premium rents, or changing property level, like physical construction items, right? So to drive down your costs. So it could be converting from a old oil boiler to a gas boiler, or insulating your roof cavity, or changing your window system, stuff that you can sort of block and tackle and reduce your expenses and enhance your net operating income. So there's that element of the value add philosophy that exists in the real estate business, not just in New York, but generally, that is a little bit different than the sort of value-focused, value-focused companies. Of course, you could find management teams that are doing that, et cetera, but it's a little less tangible, a little less concrete than it is, for real estate.
Well, Seth Wiseman has been our guest. He is the founder of Urban Standard Capital and serves as managing partner as well of Wiseman Equities and City Shares, that one word, City Shares. And he is also the owner of an aging but indomitable dog who is, we wish her, is it, Seth?
Her, yeah.
Yeah, wish her the best and wish you the best. And thank you for joining us today on Current Yield. It has been a pleasure indeed.
Thank you for having me. I appreciate it.
Yeah, we'll talk soon. And Evan and Eric, I don't know, it's the day's young. Let's do something constructive with Grant's Interest Rate Observer, shall we?
There we go. Yes.
All right.
Sounds good. Thank you again.
Okay,
No,
thank you,
of course.
Seth.
Thank you,
So long,
guys.
fellas. And thank you, ladies and gentlemen, for listening.